Hey everyone, we are the Group 6 and we are going to present our risk management plan of Metropolitan Bank and Trust Company. Before, let us introduce ourselves. I am Marjorie Joy Manisay.
I am Rosemary F. Butong.
I am Prince Grace Carbajal.
I am Lara May Lorca.
I am Jenny Intay.
This study emphasizes the critical role of banks in economic development by facilitating financial transactions and managing risk. Risk like credit, market liquidity, operational and compliance risk are challenges that banks face. Metrobank, like other banks, must implement robust risk management framework to ensure stability, performance, and public trust. The 2008 financial crisis highlighted the need for effective risk strategy. These are the objectives of the study. Number 1 is develop a comprehensive understanding of Metrobank's risk management process. Number 2, provide guidance on selecting appropriate risk response strategies. Number 3 is enhance Metrobank's preparedness for potential risk through proactive response plan.
These are the types of risk. Number 1 is credit risk. The outcome is speculative risk and it can lead to gain or loss based on whether borrowers honor their obligations. Scope, particular risk. It focused on individual transactions or clients. Description. This is the risk of a borrower, issuer, or counterparty failing to meet obligations, leading to potential losses for the bank. It typically arises from activities like lending, trade finance, or treasury operations. Number 2, liquidity risk. The outcome of liquidity risk is pure risk, and it only has potential for loss and not gain. Scope, fundamental risk. It affects the institution's ability to operate, not just individual transactions. Description. This occurs when the bank cannot meet its obligation as they fall due, impacting earnings or capital. Number 3, market risk. Number 3, market risk. The outcome of market risk is speculative risk. This results from changes in market conditions which can either harm or benefit the bank. Scope, fundamental risk. Affects the bank's overall financial condition. The description is this risk arises from adverse movements in interest rates, equity prices, or commodity prices, potentially affecting the bank's financial stability. Interest rate risk. Number 4, interest rate risk. The outcome is pure risk, and it can lead to financial loss from adverse movements in interest rates. Scope, fundamental risk. Impacts the bank's balance sheet activities. Description. It is the current and potential negative impact or earnings and capital due to mismatches in the maturity or rate structure of assets and liabilities. Number operational risk. The outcome is pure risk and it only results in losses with no potential or gain. Scope, particular risk. It is specific to internal disruptions like system failures or fraud. Its description is the risk of loss from inadequate or failed internal processes, systems, human error, or external events including fraud or unforeseen catastrophes. Strategic risk. Its outcome is pure risk. It may result in loss or no loss depending on external factors like political or legal issues. The scope is particular risk, focused on specific partnerships or decisions affecting a particular risk or particular bank. Description. Strategic risk involves negative impacts on earnings due to poor business decisions or failure to adopt to industry changes. For example, working with local partners in foreign markets can help mitigate such risk. Compliance and regulatory risk. The outcome is pure risk. Uncertainty over compliance can lead to financial or reputational damage. Scope, particular risk, focused on specific or legal regulatory issues like money laundering. Description, this risk arises from failure to comply with laws, governance standards, or anti-money laundering policies. Strict monitoring systems are implemented to avoid penalties and maintain good governance practices. Reputational risk. The outcome of reputational risk is pure risk. It can harm the organization's image with no direct gain. The scope is fundamental risk. Affects the entire company rather than a single transaction. Description. Reputational risk results from negative public perception due to events like fraud or cybersecurity incidents. Proactive crisis communication plans are necessary to address and cover from such risk. Environmental and social risk. The outcome of environmental and social risk is pure risk because it can often lead to losses, especially from unforeseen disasters or conflicts. Scope, fundamental risk, affects broader operations beyond individual transactions. And its description is environmental and social risk includes unpredictable events like earthquake or climate impacts. To address this, frameworks such as ESRM classify risk and guide sustainable decision making.
This is the risk matrix. Under the risk matrix is the legend, which is red is the critical risk, orange is the high risk, yellow is the moderate risk, and lastly, the green is low risk. So, the credit risk is critical risk. Credit risk is critical due to the potential for significant financial losses if the borrowers default on their loans. This can impact the bank profitability, liquidity, and overall the financial stability. So next is the liquidity risk. Liquidity risk is critical risk. Liquidity risk is crucial because it can hinder the bank's ability to meet its short-term obligations. If the banks cannot access sufficient funds, it may be forced to sell assets at a loss or borrow at affordable rates, lending to financial distress. So next is the market risk. Market risk is critical risk. Market risk is critical due to its potential to cause significant losses from the adverse movements in market prices. This can impact the value of banks' investment, loans, and other financial instruments, affecting its profitability and capital adequacy. Next is the interest rate risk. This is critical risk because it can change in interest rate can significantly impact the bank's earnings, and capital mismatches in the bank's maturity and rate structures can expose it to interest rate risk, lending to potential losses. Next is the operational risk. This is critical risk. Operational risk is Metrobank is critical risk because if it will be left unaddressed, the incurrence of operational risk can cause monetary loss, competitive disadvantage, employee or customer-related problems, and business failure. Next is the strategic risk. It is high risk due to the possibility of the banks being unable to achieve the objectives. Risk may possibly occur and there will be a percentage chance of loss or capital or high chance of devastating loss in the company. Hence, these incidents occurring are usually high as they are generally dangerous activities that require careful attention. Next is the compliance and regulatory risk. This is high risk. The frequency of compliance and regulatory risk in the bank usually occurs in normal circumstances. The bank will face high risk as result for insufficient control systems and might break current laws and regulations. And the institution as affected by new changes to laws and regulations might cause financial losses. Reputational risk. It is critical risk because there is a chance that the reputation or image of the company will be forever ruined, and it can affect the trust of the customers, lead to the biggest downfall. And lastly is the environmental and social risk. It is critical risk because it is one of the critical risks that an institution should focus on, because it has a chance that the institution will encounter a disaster that affect the whole economy. And there is a big possibility that the disasters are unmanageable, so the economy will be affected.
In this section of risk response planning of our risk management plan, it aims to develop and implement strategies concerning the Metrobank's identified risk and potential impacts. It involves the plan outlining the detailed actions and chosen response strategy, including its resources required and timeliness to be taken for each identified risk. This approach will reduce and avoid the risk impacts which contributed to the Metrobank's overall success. First identified type of risk is credit risk. Our response of this risk is risk reduction. We will implement specific actions such as the customer evaluation through 5 Cs, which is the character, capacity, collateral, capital, and conditions. Then financial statement analysis, credit scoring model and regular credit monitoring, loan portfolio diversification. The responsible for this job is the credit review officer, credit portfolio manager, IT professionals. And in order to implement these strategies to reduce the impact of credit risk, we need resources such as the human resources, technological tools for credit scores and regular monitoring, and funds. Since it is an ongoing process, we need to implement this plan as soon as possible. Second identified risk is liquidity risk. Our response of this risk is risk reduction. We will implement specific actions such as having enough cash on hand or cash reserves, implement strategies to control expenses, and monitor cash inflows and outflows. The people involved or responsible for this job is the Treasury Department and the Head Asset and Liability Department. But in order to implement these strategies to reduce the impact of liquidity risk, we need resources such as the human resource, technology, and the financial resources. And we will implement this as soon as possible. Third identified risk is market risk. Our response of this risk is risk reduction. We will implement specific actions such as the investment portfolio diversification, engage in options and future contracts. The people involved or responsible for this job is the portfolio manager, who shall perform regular reviews of portfolios and monitor regular market updates. In order to implement these strategies to reduce the impact of market risk, we need resources such as the financial resources or the capital, and then technology, human resource, and external resources such as the consultants and industry associations. The timeliness is it will occur as soon as possible. The fourth identified risk is the interest rate risk. Our response of this risk is to reduce, so risk reduction. We will implement specific actions such as the employment of derivative instruments, purchase interest rates, future contracts, and buying interest rate futures to lock in a specific interest rate. The people involved or responsible for this job are the Head Asset and Liability Department, who is responsible for the overall identification, analysis, measurement, and management of market, interest rate, and liquidity risk arising from asset and liability portfolios created by all activities of Metrobank. In order to implement these strategies to reduce the impact of interest rate risk, we need resources such as the human resource, capital and funds for hedging strategies, and technology. The timeline is as soon as possible. So credit risk, liquidity risk, Market risk and interest rate risk are all identified as critical risks based on our risk matrix and therefore shall be responded as risk reduction because we cannot avoid nor prevent this type of risk as they are part of Metrobank's main activities. Moving on, the fifth risk is operational risk. Our response of this risk is risk avoidance, and we can avoid this risk by implementing strong internal controls across systems such as regular audits to prevent errors, fraud, and other risks related to operation, and then invest in advanced technology and automation, invest in training programs for employees, and operate in a strategic location and have long-term plans. The people involved or responsible for this job are the fraud officer, operations manager trainee, business risk officer, and a strategic support department. But in order to implement these strategies to reduce the impact to avoid the impact of operational risk, we need resources such as the human resource, technological resources, business continuity plans, and funds. And this should be conducted monthly. The sixth type of risk is strategic risk. Our response of this risk is risk reduction. We will implement a specific action such as to support transition finance for hard-to-abate sectors through considering the provisions of transition finance to borrowers to support their sustainability journey. And then identify high E&S risk clients that require enhanced due diligence and create a roadmap to reduce high-risk exposure. And then lastly, we will accelerate growth of sustainability portfolio. The people involved or responsible for this job are the human resources, such as the strategic personnel management, also known as the strategic human resource management, and then risk oversight committee. And we will implement this as soon as possible. The seventh type of risk is the compliance and regulatory risk. Our response of this type of risk is risk reduction. We will implement a specific action such as the monitor compliance of the bank with new and existing laws and regulations promulgated by the BSP and other regulatory government agencies, and then perform the required review of its charter, and conduct an annual self-assessment to evaluate their performances against the requirements of the charter. The people involved or responsible for this job are the Board of Directors, Compliance Officer, Internal Audit Team, and in order to implement these strategies to reduce the impact of compliance and regulatory risk, we need resources such as the human resource, technological resource, and financial resource. And this should be conducted as soon as possible. The eighth identified type of risk is reputational risk. Our response of this risk is risk reduction. We will implement a specific action such as observing and conducting a behavior that comply with companies' policies and applicable laws, regulation, including the market rules. Committed and adopts a more comprehensive anti-bribery and corruption policy with highest possible standards of ethics, honesty, accountability, and good governance. Policy that also aims to mitigate reputational and legal risk. The people involved or responsible for this job are the human resources, such as the internal audit function group supervisor, advisor, and the board of directors president. And we will conduct this periodically. The last type of risk is the environmental and social risk. Our response of this type of risk is risk reduction. We will implement a specific actions such as create a risk management plan for the preparation for any disaster may encounter, and then provide equipments that may use for disasters. The people involved or responsible for this job are the environmental staff, external managers, and risk managers. And in order to implement these strategies to reduce the impact of environmental and social risk, we need resources such as the human resources and the technology. And we will conduct this as soon as possible.
Risk monitoring. Risk monitoring aims to provide insights into the likelihood and potential impact of the various risks. We start in the monitoring process. In terms of credit risk monitoring, it should be conducted at the beginning of the loan transaction. Since credit risk is an ongoing process of Metrobank's primary service, it involves a continuous evaluation or an ongoing monitoring that should occur at least monthly. The tools necessary for monitoring credit risk are risk dashboard, early warning system, and portfolio monitoring tools. Regarding liquidity risk monitoring, it will often occur monthly to ensure a timely identification of emerging risk and quicker responses. Liquidity coverage ratio is a metric that ensures banks' ability to withstand the short-term cash flow disruption by holding enough asset to cover its net cash outflows over 30-day stress period. If the LCR is high, it has great resilience against liquidity vulnerabilities, which is essential for the bank. As to market risk monitoring, it will be often monitored daily to keep updated by the changes in the market. Market data platforms include trading platforms to have access in real-time market feeds, news, charts, and track market movements. In relation to interest risk monitoring, it will often occur weekly basis to allow them to identify and respond to risk quickly. Stress testing is the test to create a scenario where interest rates rise by specific points over a short period of time to see how their portfolio would perform under such changes. Pertaining to operational risk monitoring, since it is an ongoing process of evaluation, it will often occur monthly of risk. Metrobanks include key risk indicators, internal audits, compliance monitoring, long-term planning, and cybersecurity measures. Key risk indicators provide early warning signs such as number of customer complaints, system outage, violations, and fraud incidents. Strategic risk oversees development to adherence risk appetite. The ROC shall ensure that the current and emerging risk exposure are consistent to the group's strategic direction of the overall risk appetite. It shall assess the overall status and adherence to the risk appetite based on the quality of compliance with the limit structure, policies, and procedures relating to risk management control and performance of management, among others. In terms of compliance and regulatory risk, Metrobank's compliance and regulatory monitoring process is robust and multifaceted. It involves regular risk assessment to identify emerging risk and evaluate the effectiveness of existing controls. Metrobank engaged external auditors for independent verification of compliance and risk management practices. Reputational risk is paramount. Through maintaining a low risk appetite for reputational harm, proactively safeguarding the company's reputation alongside managing others' risk. It focuses on monitoring the unfavorable ratings and concerns from customers. In relation with the environmental and social risk monitoring, since some of the disasters are not predictable like earthquakes, but some others are predictable like typhoons, it should be monitored from time to time to be aware where there's coming risk. Social impact assessment is similar to the environmental impact assessment that predicts, identifies, and mitigates the potential risk that may occur in the environmental or social.
So in this part, the evaluation of Metrobank risk may vary from the type of risk and when it should be reviewed or reported. And here are the type of risk that need to evaluate. First is the credit risk. It should be reported semi-annually or when significant changes occur. Next, identified risk is liquidity risk. It should be reported or reviewed annually. And the third identified risk is the market risk. This should be reported quarterly, especially during high volatility. So the fourth identified risk is the interest rate risk. This should be reported or reviewed quarterly during economic downturns or rapid rate changes. And the fifth identified risk is the operational risk. And this is reviewed quarterly. And the sixth identified risk is the compliance and regulatory risk. This should be reported or reviewed annually. And the seventh identified risk is reputational risk. This is an ongoing process. And eighth identified risk is the environmental and social risk. As needed, this depending on external factors. And these are the responsibilities. First is Board of Directors. Board of Directors oversees overall risk management and approves stress testing scenarios and results. Also, it evaluates risk profiles and strategies. Next, responsible is Risk Management Team. So the risk management team should oversee credit risk management process, employs risk management techniques, and monitor credit exposures. And the third responsible for this is Credit Portfolio Manager. Should maintain 5 and credit scoring models, implements loan portfolio diversification strategies. The fourth responsible is Treasury Management. Manage daily cash flows, develop plans to address liquidity shortfalls. And the fifth is Portfolio Manager. Evaluate new investment securities. Recommend actions. And the sixth responsible is Operational Risk Management. It should implement internal controls and training and combats funds. Seventh responsible is Strategic Risk Management. It should identify, analyze, and monitors risk, and also coordinate risk management across divisions. And eighth is Compliance and Regulatory Risk. It ensures adherence to laws and regulations, maintains prudential reporting obligations. And last, responsible is Environmental and Social Risk. Conduct environmental impact assessment, analyzes data, and evaluate risk. So lastly, in this part is the reporting process. Reporting the risk may also vary from the identified risk of Metrobank company. So here are each risk reporting. First is credit risk reporting. For credit portfolio manager to risk management team monthly, and second is risk management team to board of directors quarterly. Next, identified risk and risk reporting is liquidity risk reporting. First is treasury management to board of director annually. And next is the market risk reporting. First is portfolio managers to the board of directors quarterly. Next is interest rate risk reporting. First is health and liability department to board of directors quarterly. So next is operational risk of reporting. First is operational risk management then reported to board of directors quarterly again. Next is strategic risk reporting. The ongoing reviews and updates to board of directors. Then next is a compliance and regulatory risk reporting. So audit committee to the board of directors regularly. And next is the reputational risk reporting. Ongoing monitors and reporting to the board of directors. And lastly, the environmental and social risk reporting. So environmental staff to external managers, and the external managers should report to the risk managers, and the risk managers should report to board of director as needed.